Welcome to Sunday Fuel for Sunday, February 25th, where we take a week at the look ahead. I am your illustrious host and
Wait,
fearless leader,
we take a
Sacred
week
Prophet.
at the look ahead? Is that what you said?
I don't talk what you know about.
Are you having a stroke right now?
Oh, this is, I don't know, he sort of stumbled into the stream, Peter
Feels
Hartman.
that way.
Round of applause for Peter Hartman. Imagine I press a button here right now and it goes,
That's always
which
playing in my
oh,
head. It's the constant sound effect. I walk into a
yeah.
room, it's like I'm on the cast of Seinfeld.
Peter,
Yeah.
markets, the week ahead. It's looking, unfortunately, boring. I was expecting a bloodbath in markets, right? I was looking for 5% correction, 10% correction down. I had bought puts. I was ready. I was ready for it. I thought to myself, the market only drops when you're at all-time highs, right? Whenever you see freaking all-time highs, whenever you look at the peak, that's where the rug gets pulled out from under you because that's where vol becomes not well supplied, right? People haven't purchased enough insurance protection to go, hey, look, it's going up and to the right. I don't need to be as protected as was before. It's sort of like as the stock market goes down or whatever crypto market goes down, people go, oh, I need to be careful because it might go down further. And so they buy protection,
Right.
right? And that protection, the idea is that when the price falls, they get covered, they get insurance, they don't lose as much as they would otherwise, and that's one of the reasons markets don't stay down long because that protection gets monetized. They get that money back. So it's basically they're making money on the downside, and then they can go back in and put that money back to work. So they had the money that was there before, plus this new amount of money that gets recirculated. But when you get to new all-time highs again and again, then people get complacent and there's certain times during the year where all that insurance sort of gets dried up, and then if there's going to be a catalyst where, well, now there is no protection to the downside and people just scramble in order to get into it. Anyways, that's a short
But I thought
force
that, wait, we didn't hit any all time highs?
well, not in everything, but in the SPY hit a new all-time high. Not the Nasdaq, I don't believe, but the Nasdaq hit an all-time high,
Oh,
not
I
the
see.
SPY.
The only thing I think about is Bitcoin, so I didn't understand. Okay, I get it.
Well, no, I don't even for Bitcoin, you're looking at. I mean, all assets do that. It's sort of like it's when it goes up a lot and people have the amount of buying pressure
Hmm.
dissipates. Everyone who's going to buy has bought. Well, if the selling pressure doesn't dissipate, well, then you can get something to the downside. And then if you have this catalyst where you have a big drop and there's no buyers there in order to catch it, well, there's a scramble for collateral in order to buy that opportunity. But in that process, you get these huge drawdowns. People have these stop losses that are set, so it gets triggered and triggered and triggered and triggered, and as long as there's not enough buying pressure to stop it, well, that'll happen. Then
Okay,
people
so
panic. The whole thing.
I'm looking at Bitcoin and I see that we're kind of in this kind of dull area. Is that the same thing that's happening for everything else?
No, I mean some of the stuff in the traditional finance markets. I mean, pretty crazy. We've seen what's going on with the semiconductors. So the Nvidias, the AMDs, any of the AI stocks, those are going
Right.
crazy.
Right.
And then you had a bunch of earnings that came out. I don't know all the details specifically. I don't really track earnings, but we had Nvidia came out. I think they beat earnings and their stock went up 15%. I think CVNA. I think Walmart reported. A bunch of these people reported, and some are great and some are bad. But we had these large moves one way or another. So that's pretty interesting. The Russell's been climbing. Yields, 10-year yield hasn't moved that much. 2-year yield hasn't moved that much. So it's been steadily up and to the right, as you'd expect these charts. Bitcoin's bothering me because I was expecting it down on that. But I am very happy that I've been practicing this hedging strategy instead of a stop loss, which makes it so that it's not that I don't lose money. That's never gonna happen. Really, is that I don't lose nearly as much. And then, in fact, in this sense, I haven't lost anything yet because it's sort of like what would normally happen is that as the as an asset is moving, let's say Bitcoin is moving up, I have my long position, and let's say I'm up 100% in that position, something like that. Then the price starts to move against me. Well, I don't want to. If I lose 10% of that profit, like now I'm only up 90%. I don't want to cut my losses there because I know what the market likes to do. It likes to wait till I do that and then skyrocket 5x.
But
You know,
but you
like,
got 90%.
that's very funny. I'd rather have zero, Peter. I know the pain that I want. I'd rather have zero than to have 90% if a thing
People
goes up.
like you should not go to the casino. That's all I'm saying.
Well, Peter, I'm called exit liquidity, right? People can use me in order to fund their positions. It's fine. I've been telling myself I'm going to be. This is a line I'm trying to workshop, which is my stop loss is my portfolio value.
The floor.
Casino rules. I'm out when I'm at zero. If I have $0, then I can't play anymore. I go do something else.
Well, as long as you're not leveraged.
No, I'm leveraged, but I'm not leveraged to the point where I'll lose anything. I can't lose anything that's not in the account. And so I only put money in the account I can lose. And that's a small amount. That's a small amount.
But wait, isn't there leverage where
your camera's frozen? Are you frozen on your end?
No.
Oh. Am I frozen for you?
No.
All right, perfect.
I thought that you could be leveraged in such a way that you owe like $100,000 or something.
Yeah, I don't do that. I don't write options. I don't sell options.
What's the difference between that leverage and the leverage you're doing? Why isn't there a difference?
The leverage that I'm doing is that if I'm going to put $100 on a trade, that if you're not leveraged, you can only buy $100 worth of whatever you're doing. Let's say $100 worth of Bitcoin. But if I'm leveraged, let's say 2 to 1, with that $100, I could buy $200 worth of Bitcoin. But it means that if I do that position and Bitcoin falls by $100, falls by $50, I'm out of my position.
So you only do leverage. So it's the same leverage, but you don't do 100x or 1000x leverage. You do 2, 4, something like that.
Oh no, I do 100x leverage, but what it is that I do 100x leverage is just that when the price moves, so that means for every, I do 100x leverage when the price moves up a little bit. Let's say it moves up by 1%. I can make 100% on that trade.
Right.
But if it goes down, I could lose.
You can lose how much? 100 times what you put in.
No. When the price moves down, essentially whatever loss is there, let's say it's 10 cents loss or let's say $1 loss, that dollar is amplified. And so essentially, think of it this way.
I get what you're saying. I get. Wait, because if you're explaining to me something that everybody else should know, then don't explain it because I do understand. If you're explaining it to me,
I don't think it's what everyone should know.
Right.
If I have $100 and I'm betting $100 and it goes up, right, by I don't know, 50%. Now that $100 is worth $150, right? If the price moves back down, then I could be back at $100. If the price moves lower than that, 50% lower, then I'm at $50. It's just the same amount that's moving back and forth.
Right.
But if I have $100 and I put on 10x leverage, and now that my position is worth $1,000, right, it's $100 back in a $1,000 position. Right. If that $1,000 position drops by $100 worth, so 10%, right? That $1,000, if I just had $1,000, it would drop by 10%. Normally, if I had $1,000, it wouldn't be a problem. It would just be down at that 10%. But because it dropped by the total amount of my margin, now the position is liquidated. So if $1,000 a position that drops by 10%, I'm out. I'm gone. I'm cleared.
Oh, well, it seems like a better way to do it than the way where you can wake up and owe $100,000, $500,000.
Well, it's the only way you could beat the market, right? Because otherwise, if you want to just put the money in, so you put $1,000 in Bitcoin, and if it goes up and down, whatever, you don't have to worry about it. The position's never liquidated, but you're never gonna make more than what the index of Bitcoin is doing. Like your skill at it makes no difference.
That's what I'm doing. That's what I'm doing.
Yeah. So that's buy and hold, which is a great strategy. So what I used to do is just chase the market, try to time it up and down and up and down and up and down. And so as you can imagine, that's only you tell yourself, well, if I sell it at the peak and I buy it at the bottom and sell it at the peak and buy the bottom, then I'll make more money than all these losers holding the whole way
Of
because I don't
course.
have to deal with any drawdowns. But that one assumes that when you reinvest that money in, you're going all in, right?
Right.
Because otherwise, you might as well just held it. You would have made
Right.
the same amount of money, if not more. And if you don't time the tops and bottoms correctly, well, then you lose money every time you enter. As you the trade, it costs money. You could have had gains that you could have had. You don't get losses. You might exacerbate. You
Right.
might get in and out multiple times in order to get back into the trend. It's problematic. But what
And
I'm
it's
doing
stressful.
now,
My
it's
way, there's
fun.
no stress. Oh,
Well,
I've
fun.
been to the casino. I've seen the fun that people have. It's not fun.
It's funny. You can go to the casino, but you don't find it fun to go there. I can't go to the casino because I find it too fun to go there.
I find it fun to go to the casino with $10 and play the slot machines. I lose that $10, I walk out. And I'm smashing every machine on my way out, by the way. I'm still upset about that $10. At 5, I'm like, I'm out of here. And you're like, oh, just stay for it. My partner, just stay for $5 more. $10. If I've lost $10 at the casino on the machines, is because I went too far.
Well, now with the hedging strategy, because with the company that I'm working with, Traders Post, I was talking to Mike Christensen over there. He's the co-founder, and he's a big proponent of hedging, right? And I mean, I've heard hedging before, but it's like, look, I already took my idea was that I learn options so that I don't need to know how to hedge. I buy an option, the price is whatever it is, and if it goes to zero, it goes to zero. I don't have to think about it. I mean, that's not how professional options traders do it. They like go in and out of the position, but I don't have time to be thinking about that. I know what my shortcomings are. I got other things to do. I'm not sitting down watching options all day long. So I just buy in. If it makes money, it makes money. If it doesn't, it doesn't. But with hedging, what's cool is that it's sort of you get the best of both worlds. What happens is that, let's say I'm in a position and I'm up 100%, and I think the price is turning down the other way. Then I put on a short in the other direction. Instead of stop lossing or cutting out the position, I put a short on the other side. And that way, if that short falls and makes money, I can capture the money on that short and then put that money back in if I wanted to add to the long, to ride the price back up, just take that profit out if I want to, whatever it is. And so I have this long position that stays long all the time, whether it goes down or up or down, it doesn't matter. It always stays long. And my trading is counter to that. And so let's say I'm totally wrong and I get into position and it goes squirrely, it goes against me immediately, like the market gods like to do. It's fine. I'm only taken from the profit of the long that I would have had. And I don't have to think about getting back into the market. So it's like, okay, if I did that again and again, yeah, I might eat up all the profit from the long.
Right.
But then I'm really an idiot. But if I just restrain myself, and then I don't have to worry about that. And plus, I never have FOMO because I'm always in the market. Never have FOMO. And if it moves against me, I make even more money than if it never moved against me. So like against the long position. So it's pretty interesting.
Look, man, everything you said sounds good. Sounds like an awful lot of rationalization for gambling, but that's fine. I'm kidding. What do your indicators say? Your magical indicators.
Well, when I take a look at actually, let me just take a look at this is what I look at basically every day. This is my weather report on that's constantly showing here. So I take a look at the S&P, the NASDAQ, the Russell, Bitcoin, gold, dollar, oil, and bonds.
This is all covered with your signals, right? Is that what we're seeing here?
Yes, covered, absolutely. Just chock full, covered with my signals everywhere.
This is what it looks like for, like, do most people see the charts like this with a bunch of signals, or do most people look at it kind of clean?
If you're Gareth Soloway, you just put a couple of lines on and some pivots.
Shots fired.
No fault to the guy. The guy
shots fired.
no fault to the guy. Love the guy. But in fact, these are the only stuff like I watch daily. Every day at 9 o'clock, his thing comes on.
Game
30
plan.
minutes. Yeah, and I don't have to check to see, okay, what are the big things moving? If the sky fell, like he might say something about it, and then I have Twitter for the other stuff, like granular information, economic data that comes out, and blah blah blah. Perfectly happy with that.
Right.
But some people have just a couple of trend lines. Other people have nothing. They're just following candle patterns and stuff and chart patterns that they recognize. And other people look like mine or worse. Look, you don't use TradingView, I don't think, if you're not looking for nice, colorful, indicator diarrhea all over your screen.
What would you use otherwise?
I just said it. Trend lines or nothing.
Okay. All right.
Or if you had the Bloomberg machine, you'd have all kinds of other stuff you can use. But I don't have a Bloomberg machine because it costs like $24,000 a year. And I considered it. But I think for now, I like how it looks.
Would it help you to make more money if you had the Bloomberg terminal?
Help me lose money because it costs $24,000 a year.
Yeah, but the information that you get from it must be different than TradingView.
Is it going to make me enough to cover the $24,000 a year? No.
Basically, I want to
I'm
know
not a
if I should buy
gazillionaire.
it for you for your birthday.
You know what? Yeah. Yeah. Go ahead, do that. I think they have a trial. I think they have a trial Bloomberg machine.
Do they
sent to you.
really?
No, of course not.
Okay. Because I'm
Dang.
up for the trial.
A trial of Bloomberg. We'll send you a whole machine and set you up, and it's a whole custom terminal. Like it's their own computer systems. Like you can't even run it on your own
Yeah,
thing.
but it's like once they get you in there, and then they know you're gonna. It just sells itself.
No, of course not. No, that's not true at all. If you can't afford the $24,000 a year, you get rid of that Bloomberg machine to a sweat. Mon frere.
What's the resale value on? Okay, never mind. Go ahead. What are we looking at here?
Yeah, so this is S&P, so it's been it's all-time highs. It's been an all-time high since.
Oh, this is what you're saying. The rug is going to get pulled.
Well, the idea here is that these main levels that we're seeing here. Let me just turn on presenter. Each one of these levels here are like where the price might fall, right? Right here, right here. And so what happens is that short term, I take bets that are nearby for nearby drops because the prices will always revisit something, like it'll oscillate.
Right.
Say what you will, like that's what prices do. They oscillate up and down, and so you can make money, just on this trend. Let's say this trend we see up here, this trend here. You can make money if you're betting, that the prices will go up and come back to this orange line, and then go up and come back to the orange line. But how quickly it does and how sharp it does and all that is what matters. So, for example, this guy if you over here you were shorting, and you're expected to come back to this orange line over here, well, it actually stayed sideways until it hit the orange line, right? And so the idea here is that, again, price corrections can happen both in price or in time, or both. So the idea here is that if it was going to drop suddenly, then it would have dropped suddenly, like down to over here. But since it didn't, it did exactly what you wanted, consolidation. And this is where flags come from. Like the reason why a bull flag happens. I don't know if you see Gareth talk about this. Whatever a bull flag happens, where you have this move up and then the sideways move. The reason why this is likely bullish is because of this idea that eventually it will touch a stream of volume or a stream of buying that's existed for a while. It's sort of like a current inside of a river. Yeah, this is support, but it's support because you have this psychological current of buying, and so when the price comes back over here, poof, then it moves, right? Then it moves up with it
because it catches energy from that line.
Yeah, this is part of what I want to be talking about inside of the technical analysis supplemental course that I want to be doing. Actually, that I'm starting to do. I'm doing meetups right now just to get the bits flowing. But the idea here is like I'm going to be covering in the first module the dynamics of buyers and sellers, which covers exactly this type of point. Because I find that people take these technical analysis courses and then about chart patterns and candlestick patterns or what have you, but they don't necessarily understand like the psychology, like why does it actually work? Why would this chart pattern work, and how would you be able to tell if it's going to succeed or fail? So sometimes I'll watch Gareth Soloway or other financial YouTubers, and they'll talk about this idea that, oh, this is pattern happening and it might break up, it might break down, but we don't know, right? Well, if you take a look, if you're following where the stream is, where the actual orders are, well, then you do know, It's not a guess. You do know that it's going to move. I mean, very likely to move in that, unless there's some outside catalyst. It's almost definitely going to do that thing because that's what's happening. And if you don't see that current there, then the pattern is negated. Then you can automatically negate the pattern because it has nothing to do with anything. It might be since you look at Bitcoin a little bit more, I can show it to you over here. So Bitcoin here, we're taking a look at the this is the daily chart, and you see here how we went up and then we consolidated sideways.
Bull flag.
Well, consolidated sideways until we touched the first support area, which is this orange line, right?
Right.
So I had I don't know if you could see it over here. This orange thing over here, can you see it
I see orange. Yes.
over here? Oh, you can even see the orange bar. So this is telling me, so the bullish move stops. I can see it down here, like the bullish move, like it's still bullish, but it's sort of paused in its bullishness, and it's saying, "Hey, careful, we might start with like I don't know if we're gonna have a pullback or whatever, but the flows have stopped." And that's exactly what happened. As soon as that happened, the flow stopped, and the price.
When you say
is
flows, you're talking about liquidity flows.
liquidity flows. That's right. Which is what we're going to be covering in liquidity, effective liquidity, in 3 weeks.
It's crazy how a lot of people don't realize how important liquidity is.
I mean, and it doesn't help that the term liquidity is used. It's used in smart money concepts and other things. That's a different thing. Liquidity, they mean stuff like, for example, let's say over here. So you see how the price here this wick came down over here, and so they see liquidity as something like actually let's go with over here. See this order block that's showing over here, this block of green and red.
Yeah.
They'll say that a bunch of people will see this and they'll create stop loss orders. So they'll go long and create a stop loss order over here, so that if we fall down to that point, it'll trigger stop loss, which will then sell their position, right?
Right.
And so that adds to downward pressure. And so people will call this zone over here a liquidity zone, right? I don't know if that makes sense over here. This zone over here, this block that you see here, they'll call this a liquidity zone because they'll say that market makers or other traders or algorithmic traders or whatever will try to get the price over here to trigger stop losses so that it'll wick down and they can get in at a lower price and then ride the wave back up. So that's what, generally speaking, in fact, every single time I've spoken to any retail trader who hire me for scripts, that's what they mean. They mean liquidity is a zone where there are take profit or stop loss orders that are gathered. But when I say liquidity, I mean the financial term for liquidity, which is the ability to buy an asset without moving spot price. So if I want to buy $1 million of the Nasdaq, well, I could buy $1 million of the Nasdaq without the price moving almost at all. But if I want to buy $1 million of Bitcoin, I might move the price. And so the more that the price moves on a purchase, the less liquidity is said to be there. And so what happens with these currents is that, and with other things that indicate the availability of orders there, the tendency of orders there, is that it's tracking here an unlikelihood that there's going to be, so like this area over here where a bunch of these currents crossed up. So when one of my currents crosses over another one, and it's like a moving average. This is not much different than moving average. This is volume weighted, amongst other things. When it crosses over, it's suggesting that if there was going to be this selling pressure, that this cross wouldn't occur, that the price would actually come down, like it would continue to come down, like these guys are coming down. But because this is going up, it means that there's this ebbing of or there's this diminishment of sellers and increase in flow. And so when it pops over here, it's sort of like this pop. It's like this pop. It pops, jumps over the current, and then just now all these currents are working together to drive the price up, which is why you see these crazy jumps up. And so so it comes up over here, but then we're up in the air. It's sort of like we've moved beyond the current, We've moved beyond the current over here, so now we're like floating up here. There's not enough energy to get us up over there, but it's not enough yet to drop us, right? And so the idea here is that okay, we're to consolidate, and so people were looking for, even I was looking for this price to come down, and if it comes down, it would touch this orange line, and if it's a lot of selling pressure, then it would break to the yellow or it would break to the teal, and then so on. And so I was hoping that this orange sign would mean that it would hit over here around the 4,800, 47.5 level. But the long grid stayed consolidated. You're in the group that I'm part of. I'm saying if it stays sideways, that selling pressure is diminishing. This selling pressure over here ends up being a sideways thing. And look, we got close. We got right next to the. As we get closer to the liquidity line, these wicks. When you see these things where the price comes down over here and then bloop comes back up, because
Right.
that's what it means. So what means that the price came all the way down and bloop came back up to stop at a higher level. That means it's confirming that this level, this current, has a bunch of orders in there and willingness to buy. And so the likelihood is that it bounces, and that's like eating up that liquidity. So the more it bounces over here, this level is getting weaker and weaker. And then we came all the way down over here and we were dipped it into the line. But by that point, the yellow had come up closer, right? It was further down here. It was further over here. But then it got closer to the orange line. So it made it harder for it to penetrate to, right? You have these two currents moving together, and then it's getting harder still. So now it's even curling up, right? The currents are sort of like pushing each other up. So now the likelihood that we fall is not very high, except for this trend line. So this trend line is what I'm looking at. And we broke it. We even closed below it. We went back up. So it's essentially we're hugging this to see if we really stay. And if we don't, then we might stay in this area over here. And if we stay in this area over here, then the next level is over here. If the price bounces over here, then we are going to be below these two guys. And we get below these two guys and we eat in this area, then the likelihood is that we fall down to this guy, this line. And then if we do, then we bounce around and then we come over here and we fall down to this level. If we do, and then we bounce around over here and then fall down to this level, which will be over here. And that's how I use these things. And fall, and then fall down to this level over here, and then down to further still. To
Why did that?
get to the liquidity level. And if we get to this liquidity level, this is where the stop loss is, like the traditional the SMC liquidity stop losses, and then we might fall through there, and if we fall through there, we get down to this level over here.
Why would we
Which I
fall
don't.
through there? Why wouldn't the people trying to drive down the price buy there?
They might. It's more likely that we bounce in this area.
Right.
Because it was this area before. This area was created over here. It was an area of resistance before, right? The price came up over here. It bounced along the currents. It came up here, but it bounced. It's stuck inside. The currents had to literally come up and push it out of it. Poof, and then went up, where it broke a previous zone. So zoom right through there, but that zone wasn't done yet. Like it was like, okay, we went through, but there was just too much selling over here, so the price came right back down to the currents, and then it stayed along the currents this whole way, stayed along the currents until it started bubbling up, and then bubbling up, and then bubbling up, and then, but it wasn't enough. And then, because if it was enough, we would have seen these currents really start to move up, but it wasn't. And then the price came down, and so we broke down below the current level. Here it did what I just talked about over here, where it fell and then consolidated, staying underneath the level that it was at before, and then it fell. It landed on this the current, right? My current. You look at how more accurate it is to follow the currents here. It literally falls to the penny. It didn't even hit this zone over here. It falls to the penny, and over here there's enough orders for it to jump back up, but it bounced over here. It bounced on each level. It got over here, and it's like, but I still don't have enough. But it was enough to keep it up here, so it stayed in here. The levels squish, and then we did that whole thing. So I find it very fascinating to watch the market this way. It's sort of like you get to see the stuff that's floating around inside of the river, and you can like see, okay, there's a log over there, there's a rock over there. prices splitting. There's a waterfall. You can see all that stuff coming. So we'll see if we
How
stay.
many
If we,
people? Go ahead.
yeah, so we'll see. We'll see. I'm not sure what's going to happen over here. The likelihood is that the longer this happens, the more likely that we then shoot up. And if we do shoot up, it'll shoot up very long. It should shoot up even like this length. So we can get up to, I don't know, like what's the next zone up here? That's one thing I want to do, these reverse currents, because I only know the currents for the price below, but I don't know the currents for above, and I know there are currents up here, so I'm gonna have to try to find them. But the next like level I have is up here at what is it? 63,000.
And what's
think
the
so.
all-time high? It's close to
69.
69.
69.
Nice.
Yeah. But getting through here is gonna be pretty tough.
And how many people? Okay, they might not call it currents and flows and the ocean and the river and energy or whatever, but how many people are looking at the markets charts and seeing these elements, these waves?
Well, they're seeing it. You can have, because people have different kinds of moving averages that they use.
Right.
What I find is that, I don't know, does it seem like a lot of moving averages to you?
I have no idea, bruh.
Okay, so usually people will use, let's say, 1 to 3 levels like this, but I find that to be not useful at all. In fact, my levels, the way that they're set up, are set up in what would you call it? Each one of these levels is set up to represent a common unit of time for human beings. So, for example, here right now we can see the daily moving average, the weekly, the monthly, seasonal. So every season, let's say, call it 3 months, 2.5 months, something like that. Yearly, 5 years, and so on. And I go down to, a shift for a shift for work, a period for school, an episode that you watch, a segment on a news station, a moment that you might spend smiling, the
Wow.
time it takes for an idea, the length of time it takes for a decision. I go all the way down to there, all the way up to one turning, one seculum, one cycle. So I have all these different things, and then each one of those maps, depending on your time frame, to different levels. That's why there's like more of them here, and then some of them are balanced for long-term cycles. Other ones are balanced for this is there's anyways long-term cycles, seasonal cycles, lifetime cycles, and different kind of things that follow in there. So what happens is that there's, as far as I'm concerned, there's no level that I'm looking at. There's no I don't miss any levels.
Right.
There's nothing. There's nowhere really that the price falls to that generally doesn't have something to do with one of my averages. That's what I like, because I don't like when the price moves drastically. I go, oh, why did it go down there? Like, I don't really fall in that situation. I go, if it broke, let's say here the let's see this.
One of these days, you're going to have to show what a chart looks like to the average person. Like, what basic indicators does the average person have compared to what you got here? I'd like to see that.
Yeah, I don't know. I'd have to look.
Well, you say most people have
what
2 or 3, right? Moving averages.
I mean, I haven't gone to see what a bunch of people doing. I know in the communities that I'm in, people have a mess of things on their chart.
Right.
But the mess of things that they have in the chart, like, because I'm a coder, all my things on my chart I made specifically for me. Whereas a lot of people they'll put an indicator in their thing, and even though it's showing 5 things on the chart, they might only be using 2.
Right.
But they can't do anything about it because it's showing 5 things.
Right.
And so they get a mess of things, and then they're putting together a bunch of different indicators in order to try to get what they're looking at. But if you were just to look at it, you'd be like, why are you looking at all this? And I'm like, no, I'm not really looking at all that. I'm only looking at 3 things. But for me, there's not a single thing that's on my chart that I haven't specifically put there directly. Anyways, yeah. So when the price breaks one of the one of the levels, I know it's headed towards the next one. And if it breaks, let's say, seasonal, let's say here it bounced on a seasonal, then I go, okay, if it's bouncing on the seasonal, the last time it bounced off that seasonal, it bounced it off over here, like this is where it broke out of it. So if this is still there, that means this trend is still good. Then we're still bullish. I go, I don't care how dramatic this was and what the narrative was of the day or whatever it is. It bounced hard over here. That means this guy is still there. It's still good. And because this guy is weightier, longer period of time, the move up should be more dramatic. So then when my other indicator here says, hey, liquidity flow increased, it makes sense. It's because it came up from over here, bounced around and goes, hey, now there's even more flows coming in the market, get ready for it. And then this rise up like made total sense. It's not a mystery to me why this happened. Where people are over here looking at the price over here. Oh, I think that's it. I think it'll stop at the high over here. I go, it's not stopping at the high over there. What are you even talking about? Look at all this power behind this move. It just got totally juiced.
So what's happening in the week ahead? I see a red.
Nobody know, Peter. There's nobody
I
to
don't
know.
see-
I could only
I don't
take a
see
look at things that happened in the past. I can't take a look at things that happen in the future, Peter. I don't
Well,
know.
then you're useless. No,
I don't see what I'm expecting to happen.
Triangle.
Well, whenever whenever we're at a nexus of things, that's where you can't know what's going to happen, but you know
Right.
what you're looking for. So what I'm looking for over here is this bounce is totally understandable, right? And it should be a weak bounce because we're bouncing off this current over here, and it's a weak current. It's one of the, I think it's the, I don't know the name of it. I don't care the name of them anymore these days, but it's one of the more recent ones. So it's a very fast moving current. There's not a lot of energy there, and it showed, and the price came up and bounced on this trend line, right? So it broke that trend line. Let me zoom in. Make it visible. Yeah, so it bounced off over here, bounced back to the trend line, and now it's curving down, right? This liquidity, and over here, we're on the trend. If this breaks over here and closes, I want to see a close over here. Then I want to see a close over here. Then if I see that, a close below over here, which coincides with this yellow line, then I'm expecting a giant move down. If it doesn't, and it bounces over here, and then goes up, so it'll bounce, it'll go up, it'll do something like over here around the previous high. I expect it to break a little bit, come down, do whatever, come up, do whatever it needs to do. I don't know how long it takes to get up to this line, and then it'll break above this line and come down, and that come down when it goes up and breaks over here. Now we should get a bull run. And if it breaks over there, then we should head up to 63,000, right? And this is what I don't want to be chasing. I don't want to be like, oh, I'm going to chase it here or there. I just have my position on my long. I have my short on right now. If I fall, I'll make a nice chunk of change. If it doesn't, my short will stop loss itself out over here, and I'll be just long. If the price comes back in here, I'll go again and short again. If it goes up over here and does what I'm talking about, well, here I'll be even more in the profit of my long. I'll put a short on over here. Actually, I'll put a short on over here and then a short on over here. Then if it breaks, then I stop loss out and then I write it long. And that way, I don't have to worry about any of that stuff. That's the idea anyway.
So you've got it all figured out, don't you, Tom? A system,
right.
I'm pretty sure, is what they say in the casino. A system.
All right, so let me just take a look at the other stuff and then we'll let it go because that's enough for now. Let's see here. So if I take a look at gold, Peter, I don't know. People are saying gold's going to shoot up to 3,000. I'd be very surprised. I think yields I think are going back up. So this is 10-year bond yield.
What does the chart tell you?
On gold, let me see what the chart tells me on gold. Well, what I'll tell you on gold is what's happening on the dollar and oil. So dollar is saying, so dollar headed to support exactly. I did a tweet a couple of months ago, maybe 6 months ago. That was saying that what happens with the dollar is that if you take a look on a wider scale since 2008, the price of the dollar has, we've just basically been in a bull market for the dollar, right? The dollar has been since 2008 just up and to the right. But it does these things where it, 1 second. Yeah, so it does these things where it goes up, sideways, and then up, sideways, and then it comes down to near the high from before. and then it goes back up and comes down. Here it came back again to that high, and now we move to a new level. So when it breaks out to a new level, like it did over here, it broke out to a new level. Here we broke out to a new level. When it comes back down, I suspected that it would only come down to this level at the top over here, which is exactly what it did, right? So I'm expecting more of this to happen. So I'm expecting a move up for it to go up and to the right. Now, if it's going to do that, which I think it will, because I'd be very surprised if it broke down over here. I mean, this move we see down here, this move here, we saw with the central banks pumping in the most amount of liquidity they've ever pumped into the market ever.
Right.
And it was not enough to get to the dollar to the to below the high of the previous dollar cycle, right? And so same thing happened over here. So even they print, I don't see us getting lower than here, which means this guy's going up. Well, the dollar goes down. The gold goes down when the dollar goes up, except if it's a crisis. If it's a crisis that's happening, then we can get some big thing. But I'm not in any. Even if for me, I'm thinking to myself, even the dollar if gold goes to 3,000, unless you're playing that in options, it's not really worth it. Okay, fine. Let's say it jumps up. Fine, it can go up because of inflation. Am I expecting a move like this? No, because that move happens when we're by the current, right?
By the
We're
bond
not.
current,
We're like above it.
above which
So
current?
this purple one down here. So this purple current over here.
What is that?
Let me
The
zoom out even
yearly,
more,
the
you'll see.
yearly moving average?
That one would be. I'd have to check. That one is the 1391. Oh, let me just put the names on. I can't tell.
Well, don't let me derail you. I'm just curious. I'm sure regular traders know what's what.
There it is. So that one is the. I can't even see it.
You got some very colorful charts.
I think it's a cycle. I don't show them anymore because I found it doesn't even matter.
You just need to know where the.
All that matters is that it's the longest term one, right?
That's why I
and
said a
it's
year.
what the price is.
That's why I guessed the year.
No, it's longer than that. It'll be like it'll be something like. It's not the year. Maybe it's the year.
All right, don't let me sidetrack you if it doesn't matter.
But you see how the gold responded over here. It responded over here, and down here it responded. So we can get this type of move over here. But I'm not really. This type of move is not really. So we get these run-ups. I would want something like this, where the price falls down to. I don't care about these top currents over here. I want the in the current in the river. This guy made sense because this current had been bullish since 2001. This was a 10-year run, right? So the price falling over here and then running up made a lot of sense. And frankly, this required the recession, the global financial crisis. That's what this area is, the global financial crisis. So that where the gold fell in this 10-year bull run of gold. We don't have that here. It's not the same thing. I'm not seeing the same pattern. I see this. I mean, this is flag, right? This bull flag happening over here, and it bounced once, twice, 3 times, 4. Yeah, actually, it might go up over here. What are we talking about? It might go up to 3,000. Yeah, you know what? It might go up to 3,000, even with the dollar going up.
Well, gold has never been worth 0, and Peter Schiff, right?
The question is that if gold goes from 2,000 to 3,000, how much you make? You make, unless you're writing this with options, right, or some type of leverage. What are you making? And while that's happening, Bitcoin's definitely going up. So, do I want to be in gold from 2,000 to 3,000, or heck, if gold goes to 5,000, fine, right? Well, I'll have 100, 200, 300% gain positions on Bitcoin in a weekend. What do I care about gold going to the fight? Oh, I'm going to miss the boat. Peter Schiff is going to lap me. No, I don't care. Um, I find it very difficult. And then the miners are not doing well, and I hate that. And then gold is like being bought by all the central banks. It's like all the whole thing is like manipulated. I don't really like that. So I don't know. Maybe just buy calls all the time on gold. We'll see. But what it's telling me is that gold's now that
Why
I see it,
wouldn't
gold's
you?
going up and to the
Why
right
wouldn't you leverage gold if it's guaranteed to go up or not to go down?
because I could leverage.
Yeah, but
crypto.
crypto is not a safe bet, and gold is a guarantee, basically, as close as you can get to a guarantee.
I don't know if you've met me before, Peter. I ain't looking for safe bets. That's not why I'm doing this. That's not why I'm here. I'm here to make big money slowly. Huge money, lots of losses along the way, and then hit it out of the park.
Right.
Right? You know what I see myself as? I see myself as, I forget his name, on signs.
The f-
And it's like, swing away, Merrill. Merrill, swing away. And then I look up and it's the bat on the thing there, and I save that little kid's
Do
life.
you keep glasses
Be
of
an
water
alien,
everywhere
right?
just to get in the vibe?
Exactly. So when you tell me, Tom, why don't you trade safer? I look at you and I turn around. Felt wrong not to swing. That's who I am. Don't take that away from
Pretty
me.
sure
I
he
can't
was.
be nothing but me, bro. Can't be nothing but me.
Well, good.
All
luck.
right. Well, that's it for that.
I feel fueled up, fired up, ready to go. That's
Yeah.
my
And
that's my
starting every
Barack Obama.
Thursday, I'm going to be doing these. I don't know if you're going to be coming in all. I didn't ask you, but I have these 8 modules. Put them together. This is where you can get the information for free. Right, as I work through the bits, this is the open mic, working through the bits, all the stuff we've been talking about.
Oh, this is
Get this idea.
your course.
Yeah, my course, exactly. So this is the
So you go
dynamics
through
of buyers
this-
and sellers. So cover supply and demand, implied volatility, liquidity, narratives, always long, like we were talking about today. The benefit of regret, derivatives, and market cycles. And I think you do this. Each one of these is an hour. Plus, you'll have access to me. Not with this, but with the course, you'll have access to me over the period of the 8 weeks that we do this. And I think people will come out of that with sort of like, oh my god, now I could really, now I could really wrap my head around the markets. Like I was just going off these YouTube videos and I wasn't sure what's going on. But I think people will really like it. I mean, I've already, the reason I'm doing it is that people are already saying that. People are already like, this is. Tom, how do you have this information? Like, you know a lot about options, but you can also talk about price structure. You understand, about earnings reports, but also what CPI does. You get crypto and you get currencies and financial. So I just like, I'm not an expert. I'm just a jack of all trades, and people have been asking for this. So I'm going to put it together, see what people think, and there's going to be a look. It's not going to be cheap. Peter, I got a lot of failed trades to pay for. Not going to be cheap. Okay. All right. That's what you're to get the benefit of somebody. You want to. People learn from experience, right? Right. People learn, and if you learn from other people's experience, great. And if you learn from your own experience, it means that you fall into a lot of potholes. You've hurt yourself quite a bit. You stumped your toe quite a bit. That's me. I'm the guy who stumps their toe for you. I'm the guy who cuts his hand off by accident in a buzzsaw, so that you understand how to use the buzzsaw. I'm the guy who makes it so that there's a yellow sign on the ground that says slippery when wet. That's me. Sacred Prophet. SP.
Well,
I am.
we thank you for your service.
Excellent.
Your honor.
Well, that's it for today, February 25th, 2024, for Sunday Fuel, where we have a few laughs. We take a look at the week ahead. It's been fun, as always, Peter, and I'll catch you next Sunday. How do we end this? This is end on its own? Pretty sure it ends on its own.
Are you fired up? Are you ready to go?